Imagine owning a property that not only pays for itself, but also builds long-term wealth and financial freedom. What would your life look like if you weren't worried about putting in the 40 to 80 hours a week just to enjoy a few hours outside of sleeping? What would you do if you could get your time back, or at least have the flexibility to do what you want when you want it? Investing is the key to real wealth, and I personally feel that investing in real estate can be one of the best avenues to help you achieve this. But here's the thing, if you don't analyze the deal correctly, that passive income can turn into a money pit and a headache real fast. And there's a ton of risk and work that goes into doing this the right way. Today, I'm going to walk you through how to properly analyze a rental property, the loan options that you can use to buy one, how to make sure you're actually making money and not just covering the mortgage, and the hidden benefits you may not be thinking about with real estate investing. Cash flow isn't just rent minus mortgage. There's way more to it than that. So let's get into it. For those of you who don't know me, my name is Mike West. I'm a licensed real estate agent here in Southeast Michigan. I love helping people understand the home buying, selling, and investing process. And if that's something you're into, make sure to stick around. Now, a quick heads up. What I talk about in my videos is based on what I see here in Michigan. So if you're in a different market, some things might be a little bit different, but the fundamentals, they don't change. So let's get into this. What makes a good rental property? Before we even touch the numbers, let's talk about what actually makes a property a good investment. You don't just buy any random house and hope for the best. There's a strategy to this. First off, location matters a lot. Is the property near jobs, schools, highways, or public transportation? Because if it's not, you're gonna have a tough time finding tenants. Next, you need to know what people are paying for rent in the area. A property might seem like a great deal, but if no one's willing to rent it for what you need to make a profit, it's not a great deal at all. One way to check this is by looking for rental listings on various websites such as Zillow, Apartments.com, or one of my personal favorites is Rentometer. But don't just rely on the websites. Talk to local property managers, local realtors, or other investors in the area. Go to meet and greets to meet these people. They'll give you the real insight into vacancy rates and what's actually renting, the time it takes to get it rented out, and the rates renters are willing to pay based on the property and its amenities. And of course, the condition of the property matters too. A fixer-up might seem like a steal, but if you dump 20, 30, 40 grand into repairs just to make it rentable, that's money coming straight out of your pocket that you need to be able to factor in. There can be some really great strategies around these situations. We won't be talking about these in this video, but check out for a future one where we cover more strategies on that. So how do we calculate the cash flow the right way? So now you found a property and it seems like a good rental. Let's break down the numbers. A lot of people make this mistake. They look at the rent, they subtract the mortgage, and they think whatever's left, that's their profit. But that's not how it works. Here's the real way to calculate cash flow. First, you take your rental income. Then you subtract your mortgage payment, which includes your principal, interest, taxes, and insurance, what we refer to as PITI. But you'll also need to set money aside for repairs, maintenance, because things will break. It's the nature of all housing. You need to be prepared for that and not cut into your losses. Also take into consideration the capital expenditures, commonly referred to as CapEx. Now this is the big ticket items in homes that all homes need over time. Things like a new roof, HVAC system, windows, flooring, the big stuff that has long lifespans that at some point will come time to redo. Vacancy periods also need to be taken into consideration because you won't always have a tenant 100% of the time. So you need to figure out how long it should take to go through the move out process, to clean the property, to make necessary repairs, to remarket, and find a new tenant. And if you're not managing the property yourself, you'll also need to factor in property management fees too. So if you plan to scale this investing strategy, plan for these fees, because when it gets beyond your ability to manage one or two properties, you'll want that property manager to step in. So here's a quick example to reference. Let's say you buy a place that rents for $1,500 a month. Your mortgage payment is $900. You realize the roof is about 50% of its life and the HVAC has another 5 to 7 years. So you decide to set aside $150 for repairs and capital expenditures each month. You also realize it takes about 2 to 3 weeks to re-rent the home after a vacancy in this area because it's in good high demand. So that's about 5% of the year. So I'd put about 5% away each month for this cost, $75. And if you have a property manager, you're probably paying another $150 a month for that, about 10%. So when you subtract all of that, your actual monthly cash flow is around $225 a month. Does that make sense? It's still positive, you're still making money, but definitely not the $600 of profit you might have thought at first glance. This is why running the real numbers is so important. Next, what we need to determine is the ROI and how to calculate that on a rental property. So now you know how to calculate the cash flow, but what about the return on investment, the ROI? Because at the end of the day, you want to make sure your money is actually working for you, and if the investment is actually worth your contribution. Why put it in real estate instead of another avenue? One of the best ways to measure this is with something called cash on cash return, or COC ROI. It's a simple formula and it goes like this. Cash on cash return, ROI, equals the annual cash flow divided by the total cash invested into the property. And then you convert that into a percentage. So let's say you put $40,000 into buying this rental property. This includes your down payment, closing costs, and any initial repairs you might make to get it rented. And let's say your annual cash flow, the profit you're making each year after all expenses, is $2,700. When you run the numbers, your cash on cash return for this particular situation is 6.75%. That means for every dollar you've invested, you're getting 6.75 cents back per year. Now compare that to investing your money in other ways. If you were to put the same amount of money into a standard savings account, you'll often get less than 1% returns. If you left your money sitting in a high yield savings account or even a CD, you might earn about 4 to 5% interest at best. And that's before taxes, of course. Or you could invest into the stock market, such as the S&P 500, which historically has shown returns on average around 7% per year, with great periods of up and downs. So 6.75% might not seem crazy high, but that's just the cash flow from this particular example. I've personally seen some real estate investors get returns of 15 to 20% regularly, and even more with some creative strategies. It's important to know that with rental properties, there are other ways you build wealth as well. So now cash flow is great, we understand our ROI, but the rental properties aren't just about the monthly income. There are other long-term benefits too. So let's talk about why rental properties can actually blow other investments out of the water. You don't just make money in one way. You don't just make it from cash flow. You actually make it in 4 different ways. Number 1, we've been talking about already, is the cash flow. The extra money left over each month after all your expenses. This is what most people focus on. But number 2 is the appreciation. Over time, most properties increase in value. That 6.75% return we calculated earlier, that doesn't even include the potential appreciation of the home over time, which can add to your long-term gains as the property adjusts in value from the natural market movement, economic factors such as inflation, or even forced appreciation through improvements you might have made. This can be one of the most powerful but silent wealth builders that I discuss more in detail in another video. Number 3, loan paydown. When you have steady occupancy, your tenants are literally paying off your mortgage for you. Every month, a little more of that mortgage is gone, which means more equity in your pocket. Number 4, the tax benefits that come with holding a long-term rental property. This is a big one people forget about. With rentals, you can deduct things like depreciation, mortgage interest, property taxes, insurance, travel expenses related to managing the property, and even some repairs. This can save you thousands in taxes every year potentially. So when you add all of that together, cash flow, appreciation, loan paydown, and tax benefits, the true ROI in real estate can be anywhere from 10 to well over 20 to 50% depending on the deal. That's why real estate investing has created so many millionaires. You're not just making money one way, you're stacking multiple sources of wealth building strategies on top of each other. So now the question comes in, how do we buy these properties? How can I finance a rental property? Because real estate investing isn't just for the super wealthy and corporations that buy everything in cash or from big slush funds of money. In fact, the majority of owners of residential real estate that is used as an investment is by simple, everyday people like you, mom and pop style. Whether it was a property they may have inherited, one they paid off already but decided to move on but kept, or intentionally saved and built up on their own to help them improve their lives and their family's life. Real estate investing is for everybody. So now let's talk about how to actually buy one of these properties, because not everyone's out here paying cash. There are a variety of creative ways people can use to purchase real estate, but here are some of the more common loan options that you can use to help you buy a rental. Number 1, most common, is going to be a traditional conventional loan. Fannie Mae, Freddie Mac, this is the most common option. You'll typically need to put down about 20 to 25% for the investment property, and in some cases I have seen it go up to 30%. There's a really cool strategy known as house hacking, which you can use with a simple FHA loan product. Now, this house hacking strategy, you only need to put down the minimum of 3.5% down, or sometimes 5% down. But what you do is you live in the property for at least a year. and make it sure it's your primary residence. But this works really great for duplexes, triplexes, and fourplexes, where you can live in one side while renting out the other units to help lower your own housing expenses and save more money to invest. In the future, when you move out of that house into your next property, you now have 2 units that are renting for you. The DSCR loan is another great product. These are special investor loans where the bank looks at the property's cash flow instead of your personal income to fund the deal. You usually typically need, again, 20-25% down for this type of loan, but it's great because it's a product that you don't have to personally qualify for using your income. Portfolio loans. If you're planning to buy multiple properties, some lenders offer portfolio loans that can let you finance multiple deals at once. You'll want to shop around to see who is capable of doing this in your area and what their terms and pricings may be. And if we want to get into an even more creative option, seller financing and private money is another way that you can get into this. This is where you negotiate directly with the seller or use a private lender, a friend, a family member who wants to invest into you and your business instead of using a traditional bank. This can include things like land contracts, sub-twos, and other creative strategies. This is directly between you and your people. Hard money loans are also an option. This is where an accredited investor funds your purchase and sometimes the rehab costs of the property as well for a short term so that you can get your foot in the door to begin investing into it until it can be sold or refinanced into a more traditional product. I typically see people use these products when they're doing fix and flips or even BRRRR strategy homes. Owning rentals can be an amazing way to build wealth, but only if you analyze the numbers the right way. So if you're thinking about investing in rental properties, or you just want to know more about what's happening in Southeast Michigan, in my market, reach out. Also, let me know in the comments, what's been your biggest challenge when analyzing rental properties? And if you got any value from this, don't forget to like, subscribe, turn on notifications for more real estate investing tips and videos from me. If you'd like to catch up, you can reach me on my personal cell, 313-288-0553. I'll see you in the next one.